Good afternoon, everyone, and thank you for joining us for our monthly international market update for April 2024. Audio em português também estará disponível. I am Niraj Patel, the Chief Equity Strategist at Itaú, and I'm joined by Marcelo Aagesen, who's the Head of Global Markets and Strategy, who will be our moderator. Today, we wanted to focus on the US elections and what it could mean for the economy and markets. We're still very early in the election cycle, but it is also right around the corner and will be a long, drawn-out battle. From an equity market perspective, US election years have been historically good years for the market, as on average, it has been up more than 75% of the time with double-digit total returns. Obviously, averages can be deceiving, and elections can be overwhelmed by many other factors, as 2008 was an election year and we had large market losses. We have brought back Paresh Upadhyaya from Amundi, who was our first outside guest to join us for a market update a little over a year ago, and he now has the honor of being our first outside guest to return for a second time. So we thank him for joining us again. Lastly, besides a discussion on the election, we will leave some time for some other topics that are driving markets with stronger than expected economic data, and we're about to start first quarter 2024 earnings season. Marcelo?
Thank you. Thank you very much, Raj. Thank you all clients and peers and partners that are joining us here today. And thank you very much for coming back. Paresh, it's a pleasure having you here again. We were commenting just before the live. This is probably the whole for being too good in too many topics. So we're happy to have you here, especially for this such important and such eventful theme. Now, just before we go over a little bit on Amundi, of course, and starting with the questions, I just want to say the way that we design the investment committee on a monthly basis, we try to stay away from political noise. So we don't necessarily base investment decisions committee, so strategic and tactical asset allocations based on politics nor polls, right? So we try to stay away from that. Now, it would be naive for us to say that that doesn't impact markets or sectors or outcomes, especially when it comes to fiscal policy, even monetary policy. So we're gonna try to tackle all of that and set the ground, set the stage for what's happening later in the year. So November is the actual elections. We are early in the year. We're definitely going to bring the team back when we get closer to the elections. But right now, we thought it was a great idea for us to set the stage, understand where we are in terms of the race. Trump has just been nominated as the candidate for his party and everything else that's been happening so far. So as you mentioned, Raj, it's going to be a long run, but never too soon to start understanding and discussing this, which is a theme that has already been part of our conversations for at least 6 months now. So thank you very much for introduction. Again, Paresh, thank you for coming. Paresh, we mentioned this last time, but I don't think it's never enough for us to repeat. Paresh is Senior Vice President and the Director for Fixed Income and Currency Strategies within Amundi. Amundi is the largest asset management in Europe with over $2 trillion in assets under management, and it's between the top 10 within worldwide. So Amundi is a big, and also a big partners of us, right? Within Itaú, we distribute a couple of products. We've been around for quite a while. So again, it's very good to have you around. Welcome, Paresh. If you want to do a quick intro as well, please feel free. It's an honor to have you here, and then we kick off with the questions.
Well, Marcelo, Raj, thank you very much for inviting me to speak to your team for the second time, and the first one to be allowed to speak for a second time. I'm honored, and I think, Marcelo, you did a pretty good job introducing me, so I'm happy to just jump right in.
All right, sounds good. Thank you. So I think, as I mentioned, I think the first thing first. Let's maybe set the ground and where we are in terms of the race. So obviously, everybody heard media headlines. The focus is going to be Trump versus Biden and what that means for market, but where we are in terms of the elections and even the process itself, right? Maybe we can set the stage for us on where we are right now on the race itself. Let's talk about the process of the elections.
Sure, that's a great place to start, and I agree with you, Marcelo, that it is really early right now to be taking the polls
Sorry,
seriously.
quickly. Do you mind do presentation mode just to get the full
Oh,
screen?
yes, yes. Let's take, let me
Sorry to
see.
interrupt.
No, that's okay. Let me slideshow. Okay, I think this should work. And please let me know if that's
Yeah,
not better.
we're good. We're good. Go ahead.
Okay, great. So where are we in the race? As of the polls, if you look at the poll on the right, the polls have tightened up quite a bit. Trump has been ahead for much of the period since last summer, from August onwards. Trump has enjoyed a pretty steady lead over Biden. That has now closed somewhat, with Biden now down under 1%, about 0.8 in the poll of polls. And you can see that virtually it's now closed to neck and neck. Biden received a pretty good bump after his State of the Union speech. But if you look at the chart, so that's the lay of the land in terms of where the polls stand. On the left is from predicted. Those are what I look at to get market expectations. It's a political betting site to get a better sense of what market expectations are. And there you can see that Biden has been ahead for much of the period since March of last year. And right now, the markets, based on predicted, is putting in a 56% probability of a Biden win versus about 44% or so for Trump. So a very close race. I would call it a coin flip right now. It can go in either direction. Then it's the Electoral College and not the popular vote, as we all know, that determines the state of the election. And right now, you can see that it is a neck and neck race, even a tighter contest, with Trump ahead with 235 electoral votes in terms of how I see the Electoral College, with Biden at 226. There's about 6 states that I would distill, that I would focus on and start focusing on the state polls to get a sense of who's ahead, who's not. That's Nevada, Arizona, Georgia, Pennsylvania, Michigan, and Wisconsin. Based on a poll of polls from the swing states, Trump would sweep all the states except Pennsylvania. That's the only state that Biden enjoys a very tiny lead, and even that is under 1%. The thing I would add is the way this map is set up, we are very close where this could be a tie. Now, if Wisconsin, Pennsylvania, and Michigan, if these three states go blue, and if Georgia, Arizona, Nevada go red, and the one electoral district around Omaha, which Biden took in 2020, if it swings back to Trump, then we have a tie. But I don't want to go down that rabbit hole. What I'm saying is the stage is set with what could become a very messy race. But let's hope it doesn't get too messy.
Awesome. Yeah, and I think this is very clear. Then, as you mentioned, Paresh, it's a coin flip right now. So again, too soon for at least start trying to figure out who's going to be the winner, but at least try to understand what would happen in any one of the scenarios. Of course, it's not as simple as that. We always got to think about the other houses as well, who to have control, but we'll get there. I'm sure you're going to go over that in a few. So there's one thing that I think it would be similar in a very oversimplistic way for both candidates would be fiscal spending, right? For different reasons, but I think for both of them, we would end up in a more expansion kind of phase from a fiscal policy perspective. So can we go over what would look like for the next 4 years, depending on the candidate that wins, and also maybe touch on the control of the other houses, how that could affect potentially also this fiscal policy scenario.
Great. So let me start by just laying the foundation. Fiscal policy is probably going to be the most important and the most complicated issue that either side, Democratic or Republican, will have to solve. For one thing, the budget deficit has become a structural problem. This chart looks at the primary budget deficit, so that's the deficit stripping out interest expense. And that is the dark blue line, which is the right-hand axis, and this is as a percentage GDP. The light blue line looks at the unemployment rate that's inverted. And you can see that from 1993 all the way till about 2014, you could see that as the primary balance moves to a surplus, you could see that has correlated pretty well with low levels of unemployment. So you can see here an unemployment rate of around 4%, 4.2%, and a budget surplus around 2000. And that relationship, as you can imagine, as the unemployment rate widens, the government loosens the purse strings and begins to spend to help stimulate the economy. And that helps in turn lead to a widening deficit. And then as the economy improves, the government retrenches and the deficit begins to reduce. Look what's happened since 2014. That relationship has broken down. Part of it was aggravated by the pandemic in 2000. But even before that, you can see how even though the unemployment rate was moving toward 50-year lows, below 4% unemployment rate, you could see that the budget deficit no longer was in balance and actually was in a deficit of 4%. That break is a structural one, and one that is a reflection that debt service costs are becoming a more meaningful, having a more meaningful effect on the overall budget deficit. The chart here looks at how this is now becoming a structural issue and not a cyclical one as it has been for a while. The chart on the left looks at the primary deficit, and you can see that the deficits from 2023 onwards remains in deficit, and these are
I think we might have small technical problem on Paresh, but that's fine. We can wait for him. Meanwhile, Raj, just before Paresh gets back online, maybe
we're
we
going to
should see.
exceed.
Oh, there we go.
We're going to exceed 6% of GDP and get pretty high. And as a result of persistent growing budget deficits, the debt to GDP is exploding. And you can see that the budget deficit is now up to 180% of GDP.
I think we missed
Can
you
you-
for the you broke for a couple of for a few seconds there. Can you go over just the first graph again on the right? We got the full explanation on the,
Oh,
on the right
yes.
one. Do you mind
Okay.
going over? Sorry about that. I think
Oh, no,
we
no,
lost you.
apologies for the
Oh, okay.
connection. So I guess what I was saying is that because we're running persistent primary deficits, that's going to cause the budget deficit to begin to widen. And as a result, the debt to GDP is set to balloon quite dramatically. We are right now 98% of GDP, and that is set to hit 180% by 2053. Now, this chart here is a sign of what's to come going forward. This, I think, is very interesting. The orange line is defense spending, and this is in terms of billions. So this is $1 trillion. And then the red line is your net interest payments. So the cost of servicing our debt. 2024, for the first time, net interest costs are going to exceed spending for defense. So by itself, as a single line item, only Social Security and Medicare are 1 and 2. Net interest costs will now be the third largest spending item in the budget, which is staggering. And this is only going to balloon further. Now, I don't want to make this sound so depressing, but I want to emphasize how important and serious the budget situation is. This is a scary chart. This is a chart I like to say for Halloween. but I'm going to pull it out right now. Um, it gives you a sense of how daunting the fiscal situation is in the US, and it also gives you a sense of how impractical and how difficult it's going to be to resolve the situation pretty quickly. Two charts here. The question I'm asking is, what is required to balance the budget deficit, so bring it to balance, and to stabilize to debt to GDP at 98% of GDP, which is where we are right now in 2024. The chart on the left is looking at spending. So if we were to cut spending, we would need to cut spending. This includes the entire budget, 26%. So 1 out of 4, massive cut in spending to balance the budget. That will also stabilize, an 11% cut in spending will also stabilize the debt to GDP at 11%. But let's assume that we can't touch the holy grail, Social Security and defense. If we can't touch that, everything outside those two items, we need to cut the spending by 44% and to cut in order to stabilize the budget, and 19% to stabilize the debt. But then let's assume you can't touch Social Security, you can't touch defense, and you can't touch Medicare and Veterans Affairs. You have to then cut the rest of the budget by 76%, and that would then cut spending by 34 to stabilize the debt. As you can tell, very impractical. If you look at the chart on the right, what is required in terms of hiking taxes? So it's not all about cutting spending, but what about if we hike taxes? Same thing. If we were to hike taxes for everyone, from lower to middle income to upper income, we would need to hike taxes by 31% in order to balance the budget, and hike taxes 14% in order to stabilize the debt to GDP at 98%. But if we were to restrict that to those in the upper income, $200,000 or higher, you would have to hike taxes 47% and 21%. And if you go by just Biden's proposal, who mentioned in the State of the Union, he will only hike taxes to those making $400,000 or more. To that group of voters, to those group of earners, you have to hike taxes 74% and 33% to have those achievements. Very impractical, but it really gives you a sense of the deep, deep hole that we find ourselves in. And now I want to talk about the fiscal agendas. So, Marcelo, as you mentioned, there's really 4 scenarios to look at. Ideally, the markets like one-party rule in a sense of trying to get an agenda done. In some cases, that's positive for the markets. In other cases, may not be as positive. The number 1 scenario is a Republican sweep, probably has the largest plurality in terms of odds. I would put that as a 30 to 35% odds of a Republican presidency. Republicans flip the Senate, which is currently controlled by Democrats, and then Republicans maintain control of the House. This table I put together to give you a sense. Everything to the right of this line is easier fiscal policy. Everything to the left of the line is fiscal austerity. Everything to the top of the line is if we see united government, and everything below is if we see a divided government. And then I would say I would focus on basically if we see a unified government, and if we're in an environment where the political support is for fiscal austerity, then I would expect this is an environment where the deficits will increase. Democrats will propose a tax hike, which will offset new funding programs and refundable credits. Republicans will propose tax cuts, higher tariffs that could offset modest spending. If we go to divided government, if we see divided government, I would say that Democrats will seek to cut spending, restrain growth, but we're not likely to see any tariff increases. As we know from President Trump, he has proposed tariff increases, and that could lead to a fiscal contraction. This is sort of the area that could lead to a narrowing budget deficit. The worst case scenario is here in the upper right-hand corner. We have unified government and fiscal policy is easy. There isn't any political support to bring down the deficit. Then the Democrats will want to pass as much as they can from Biden's Build Back Better. He will implement a child tax credit, expand affordable health care, and the first-time home buyers tax credit that he rolled out during the State of the Union. Republicans will extend the tax cuts, cut corporate taxes, and perhaps boost investment and defense spending. What I want to do on this table is to give you the Trump agenda and the Biden agenda for 2.0. Now, Biden is the only one of the two candidates that have released a more detailed fiscal plan. Trump's is still a bit more general and therefore hasn't been as thoroughly vetted. If we start with Biden, he's already talked about extending middle-class tax cuts, and those are the Trump tax cuts that expire on December 31st, 2025. If those tax cuts are not extended, taxes will rise to the tune of between 1 to 1.5% of GDP. Biden has also talked about increasing taxes for those making over $400,000. He's also talked about restoring the child tax credit. He's talked about increasing corporate taxes from 21 to 28%. He's talked about implementing an international corporate minimum tax rate of 21%, so no country can have more favorable tax rates than others. And he's talked about raising the excise tax on corporate stock buybacks from 1 to 4%, enacting a wealth tax to those that have wealth in excess of 100 million, and that would be 25% minimum wealth tax. And then finally, create a first-time home buyers tax credit of $10,000 over 2 years. Now, Trump, on the other hand, he wants to fully extend his tax cuts indefinitely. He will look to cut corporate taxes from 21 to 15%. He wants to repeal some of the green tax credits that Biden had in the Inflation Reduction Act. And then he wants to repeal the 15% minimum book tax and the 1% share repurchase tax. So you can see that from a fiscal perspective, the two candidates are actually very different. I'll stop there before, unless you want me to jump right into tariffs. But I'm happy to.
So just before we go over tariffs, and we could spend some time talking about all the graphs and the Halloween slide that you showed, which is quite scary to be honest. But we'll see how that plays out. But also in the agenda, we could definitely spend a lot of time talking about what would be the effects for the dollar and also for fixed income and rates, because that's definitely going to impact not only the debt but also markets. But I just want to move very quickly to the let's put the fiscal away for 1 second and move to monetary policy, right?
Yes.
Even though the central bank, it's supposed to be independent, and it is up to a certain point, we would say. At least the discussions around it's how much of the central bank is actually independent, or and you can get arguments both way, right? But at the same time, Trump already said that he will not reappoint Powell for his third term. So at least there's some sort of impact right there when you nominate someone else. How do you think that would be? How do you think monetary policy would evolve in both scenarios here as well?
Yeah, I mean, let's start with Trump 2.0, right? His background is real estate, right? As someone in real estate, you have a preference for low interest rates, right? Low mortgage rates, that sells homes, and that's quite positive for real estate. It's no surprise that Trump, who expressed some concerns about appointing Powell as chair. He's come out, as you mentioned, that he would not reappoint Powell to another term. I think my initial assessment is that Trump is going to favor someone who is going to be more dovish on rates and on monetary policy. So the risk is that you get a more dovish Fed chair, and that will be negative for the dollar because interest rate differentials will start moving against the dollar, and it's going to be positive for interest rate sensitive sectors of the equity market because those are the economies that will benefit. So construction and the housing sector, those are the stocks that I would imagine that would boom in that environment. At the same time, I think that in fixed income, rates would sell off because it will be seen as a central bank that is not following prudent monetary policy. So as you would imagine the dollar weakening, you will see that interest rates will begin to increase as the markets become worried about the central bank independence and central bank following much easier monetary policy than you would expect. And in the long run, that would be inflationary, and that's probably not good for equities from a long-term perspective. Certainly, that's a risk that I see if there is any signs that that Fed independence is in jeopardy. And the chart I have here is just looking at the nominal neutral Fed funds rate. To what extent, how much will the Fed perhaps cut in this coming cycle? And after today's inflation number, I think it made it very clear that the table is not set for the Fed to begin easing. We had a CPI number that came in much higher than expected. I think the real risk is that with the economy growing above trend and with inflation that is proving to be much stickier than expected, hard for me to see the Fed cutting in this environment, which is why I think the odds that we see no cuts between now and election day, I think are pretty high. And I think the risk for the first cut may not be pushed back until after the election.
Yeah, no, I agree. We've been having similar discussions, especially after this morning's number. But then again, I think the term of the year, I would say it's data dependent, right? So we're still gonna see a little bit more, and I'm sure Paul's having similar discussion, maybe a little bit more in depth, but we'll see. But yeah, I think you touched on tariffs. Tariffs. I think that would be the next question that I have for you. How would, besides the fiscal and monetary policy, of course, how would that been a lot of talks about increasing tariffs? Can you comment a little bit on that, and what would be the meaning of that for the economy and markets?
Sure. So this is the exact flip. As I described earlier, Biden has a more comprehensive tax or fiscal agenda compared to Trump. On the tariff side, it's the exact opposite. Trump has a more comprehensive agenda than Biden does. So let's start there with Trump 2.0. He has talked about, and again, none of this is etched in stone. A lot of this is what has been discussed and disseminated through the media. Trump has expressed perhaps willingness to slap on a universal 10% tariff on imported goods across the board, all partners, allies and non-allies. He's singled out China as implementing 60% tariffs on China alone and no one else. He's talked about implementing reciprocal tariffs on countries imposing tariffs on the US. So if a country comes and says, we're unilaterally imposing a 20% tariff on US goods or a specific sector, then the US will retaliate by slapping on a same tariff on the good from that country. And he will monitor any country that appears to be manipulating exchange rate that could impose further tariffs. Now, that's what Trump would like to do. Biden, on the other hand, has not mentioned and is not looking for any tariffs. So I would expect status quo on tariffs on the trade side. He will look to renegotiate the USMCA, formerly known as NAFTA, when the next round when comes up in 2026. And by the way, Trump will also have the opportunity to make those negotiations. I think that Biden, along with Trump, will continue to limit Chinese access to the U.S. market. I don't expect any change there as well. So let's look at Trump's proposal. The chart on the left goes back to before the Great Depression, 1929. And this looks at the effective tax rate in the US. And you can see how it's been on this downward trend all the way till about the early 2010s, where we bottomed out at around a 2% effective tariff on foreign goods. Then the Trump tariff, the Trump trade war, tariff hikes occurred. He basically hiked on China only, but that was enough to increase the overall effective tariff in the US by 1%. And since then, under Biden, it's sort of, the total hike was 1.5%. Under Biden, it's come off about 1%. So to throw you a statistic, every 1% increase in the effective tariff rate would increase government revenues by $30 billion or 0.1% of GDP. So that's what the Trump tariffs have done. Now let's take a look at his proposals, and I'll give you a sense of how dramatic the trade landscape might look like. He's talked about that universal 10% tariff on all goods. That 10% would bring up would raise the effective tax tariff from 3% to 13%. We would be at an effective tariff rate that we have not seen since the 1930s. If we see the tariff hiked only to China by 60%, because China is a huge trading partner, the third largest to the US, that would raise the US effective tariff rate just over 8%. So it would take us just over 10%. So that would be a pretty massive increase. What would that do to revenues? So as I mentioned, a 1%, so this is a 1% hike in the effective tax rate, will add $30 billion to revenues. So you can see here that a 10% hike will basically boost the government coffers by some $300 billion. So you're looking at a pretty big increase. And what I would say is that the impact of this, so if you look at on China alone, it would boost tariffs by $250 billion, and then a 10% tariff on goods not covered by free trade agreement, because under the USMCA, Canada and Mexico cannot be touched. And therefore, because of that, it's a smaller group of countries, so that 10% becomes closer to 0.7. But all of these proposals would increase revenues to the government. This impact overall is inflationary. So if you looked at the 1.5% increase in the effective tariff rate from the Trump tariffs back in 2017 going on to 2019, we saw a 1% increase in the effective tariff rate cut GDP in the US by 0.15%. So that's for 1.5%. It increased core CPI by 0.1. So you can see that the postmortem on those tariff hikes is that growth took a hit, and that is US consumer, and inflation went up. And that's, again, only for a 1 to 1.5% increase in the effective tariff rate. If we're looking at these measures, 10% on all goods, 60% just on China, you can see that the impact is going to be pretty significant on growth and on inflation. And therefore, Fed will have to step in and react to this by tightening policy. And therefore, you see downside risk to growth, and probably an increase in risk aversion is something that we may see as a result of these tariffs. Again, it's a proposal, doesn't mean it's etched in stone.
Of course, but at least shows direction, right? And regardless of the magnitude, I think it shows. But to be honest, we are gonna need something a little bit more drastic if the idea is to rebalance budget. But then again, thank you very much for painting the scenario. Even though I'm getting more and more depressed as the live goes on, but we'll still here. Go. Just before we conclude and maybe tie everything together, Paresh, and you provide us with so much information. Raj, do you mind if I pick your brain a little bit on what would that mean for the U.S. market, stock equity market, right? And maybe any a scenario also for sectors. Paresh already mentioned, at least from a monetary policy, if it's more dovish, we're gonna see housing and construction. But can you give us a little bit of your piece of
Yeah.
a piece of your mind on that?
No, and look, we look at sectors. We have sector recommendations, which we make. We have a product to market monitor where we communicate what our views are on different sectors. We've had for a long time an overweight in U.S. equities around technology and healthcare, and so that's kind of the core view that we have. But when you look at the election, what Paresh outlined, maybe to make you feel a little bit better. Under Trump, energy will probably do well. He's talked about opening up more drilling activity. I think you'll get more approvals faster for pipelines and other projects. So I think the energy sector infrastructure, there would be more supply, but I think here, Trump has also been very hawkish around Iran and Venezuela, other places where you've seen production come back. So I think the net of it would probably be good for the energy sector. Paresh mentioned the tax rates around the corporate side. If you were to compare Trump versus Biden, you'd see, domestically focused companies would see a bigger move in the tax rate, right? Because a multinational would not get the full impact on their overall revenue because some of their revenues are offshore. And again, a lot of this depends on the details. Paresh mentioned if there's a minimum tax globally set, it could have some changes. But ultimately, if you're getting a lower corporate tax rate under Trump, then US focused companies, let's say a company that has 100% revenues in the US would then see the full benefit of that corporate tax change, all else being equal. And small caps, which tend to be more US focused, right? If you think about it, a lot of the large multinationals have much more revenues and profits from outside of the US than a small cap company in the Russell 2000 as an example. So I think that kind of gives a sense of the differences if you're just looking at the corporate tax rate, energy, which I mentioned. And then under Biden, there's been a lot of bills around the Inflation Reduction Act, CHIPS Act, so things that will, infrastructure related will continue to do well. There's probably some debate around clean energy because you've seen some maybe oversupply in certain parts like the electric vehicle market, but generally, Biden is supportive of the move to cleaner energy. So that will probably, those sectors would probably do better under a Biden presidency. So that just gives kind of a lay of the land in terms of sectors and how we think about what it could mean for different sectors within the S&P.
That's awesome. I think this is the first time that I have a conversation with you within the next year that we don't touch on AI yet. We're gonna get there. We're gonna get there. I think AI is such a big thing. Jokes apart. All right, so coin flip at this point with actually chances for a tie. We'll
That'll be the next one.
yeah, let's see if we get there. 150 different moving parts, so it's still a lot to happen in the coming months. But if you need to tie everything together, maybe coming up with some sort of a conclusion or initial conclusion here, Paresh, how would that look like?
Yeah, I mean, I'm going to echo a lot of comments that Raj has mentioned. It's definitely not all gloomy. I mean, with Trump, equity markets did very well in his tenure as he cut taxes, and his proposal to extend the tax cuts, cut corporate taxes, I think is mostly very positive for equities as a whole. I think defense and energy sectors are probably are some of the winners in a Trump presidency. The rate outlook, interest rates could rise if we do see the extension of tax cuts, if there's any signs that spending is increasing and leading to upward pressure in the budget deficit and the debt, you could see rates sell off in that environment. And for the dollar, I think the uncertainty over trade policy, the large portfolio inflows into equities, particularly from overseas. The uncertainty over trade policy, I think, is going to help the treasuries get the flight to quality bid to it. All of that is actually pretty good for the dollar as a whole. Under a Biden presidency, with all the talk of tax increases on corporate buybacks, hiking the corporate tax, and then a potential wealth tax, that could make equity markets a bit on the defensive. Doesn't mean that everything is going to sell off. Probably some of the green energy firms are going to be winners. Infrastructure, some construction may do well in that environment. On the rate side, I think the fact that the fiscal outlook is more spending and perhaps a risk that deficits increase, that's going to put rates on the defensive in that environment. And as a result, higher interest rates are positive for the dollar, as interest rate differentials will move in favor of the dollar, and that'll be positive for dollar. So, that's kind of how I'm looking at the policies between Trump and Biden and the impact that that could have on financial markets, at least this point in time.
Yeah, that's a great summary. I've been getting a few questions in terms of if we can or cannot share the presentation. We're clear with compliance, and of course, Paresh, after a while, when we get back to your banker specifically. And there are a couple of questions that I thought it was they were interesting in terms of external policy, right? We're living we're seeing at least two main wars across the globe, and how the U.S. would present itself under the two presidents, if you have a view on that, both from a Russian and Ukraine perspective and Middle East.
Yeah. Well, if we look at Biden 2.0, that's probably the easiest. What Biden has been doing is he's been strengthening alliances around the world, whether it's strengthening alliances in Europe to help check Russian aggression in the region, to help strengthen alliances in Asia, the creation of AUKUS, the resurrection of Quad, which, by the way, started under Trump, but I think was strengthened further under Biden as a check on China. You could see U.S. policy pretty clearly, foreign policy under Biden. I think he would maintain that course of building alliances, which I think is going to be Biden's main focus, to support allies, provide all of our allies the military support, the diplomatic support, and the economic support to check aggression and to promote democracy. Under a President Trump, you can see his appeal is more isolationism, and you see that particularly with House Republicans, that the U.S. cannot be the global policeman, and that we need to get our house in order, and therefore what I would see Trump doing is moving away from alliances, which means you may try to see Trump make a greater push for diplomacy between Russia and Ukraine to try to resolve the conflict, maybe keep it frozen, which indirectly gives Putin a win. It may give him the signal that Western resolve may not be as strong, and the risk is that Putin may want to try to move into perhaps Eastern Europe, which could raise tensions with NATO. I think that Trump seems less interested in defending Taiwan, unlike Biden's comments over the last few years, and therefore, you could see the Chinese perhaps take maybe bolder action against Taiwan in the coming 4 or 5 years. I think for one thing, I think countries under a President Trump will have to try to figure out what is the best way that they can defend themselves. And you're going to see a lot more alliances within the region. So Europeans trying to do the best they can with lesser US involvement than we've seen in the past.
Very interesting. Very interesting. All right. We do have a few questions popping up. I do have so much that I would like to explore. I'm also probably one of the ones that want to receive the presentation to go over and try. But we've been trying to wrap up a little earlier, or at least give shorter or smaller pills for market update, even though I do want more and more. So this is one of the things that we're receiving feedbacks from clients and for internal partners. I do appreciate everyone being here with us today. Such an interesting theme, to be honest. I'm sure this is definitely not the last time that we hear about US election. It's probably the beginning of it. So I'm happy to be jumping on this early in the year and long way until November. Paresh, thank you so much for joining us again. A lot of knowledge, a lot of interesting data, and very nice presentation. I appreciate the cleanness and the direct approach. Raj, of course, always a pleasure being here with you. And thank you to all the clients that attend us.
Thank you, Paresh. Thank you.
Thank you, everyone. Thank you, Marcelo, Raj. Bye.